Hi everyone, thank you for joining today's webinar. The name of the webinar is Overview of Quantopian-Based Paper on Momentum with Volatility. Today's speaker is Yulia Malitskaia. Yulia is a researcher at Vicky Analytics, focusing on multi-factor portfolios and factor investing. She holds degrees from NYU Stern School of Business, University College Cork, Ireland, and the University of Cambridge. As a quick note, this webinar is being recorded and will be reposted on this channel in a couple of days, so you will be able to rewatch it here. For the question and answer portion of the webinar, which comes at the very end, we are going to be picking questions from the chat. So if you have a question for Yulia, you can post it in the chat and we will try to answer as many of your questions as possible. There is a link to Yulia's forum post in the description of this post where you can ask remaining questions from members of the community. Yulia has also been very active answering questions in the post. Thank you so much, Yulia. With that, let's get started.
Thank you for the introduction, Saba, and thank you everyone for joining. Today, I will be presenting a webinar entitled Overview of Quantopian-Based Paper on Momentum with Volatility Timing. And I would like to begin with the main takeaways from the paper, which were as follows. First, the paper highlights the broken behavior of the conventional momentum factor during a market downturn and proposes to take these results into account before applying existing and new solutions for mitigating factor performance. Second, it proposes to apply the realized volatility from volatility scaling methods explicitly as a timing signal for capturing the corresponding time intervals. And finally, it presents the volatility-timed winners approach for implementing and transparently addressing the above statements. In this slide is the outline of the webinar. So we will begin with a brief overview of the background information and literature review. In the second section, the volatility-timed winners approach will be presented. Then in the third section, the proposed method will be considered within the context of the time series momentum and risk-based asset allocation. Then the proposed method will be assessed with Spearman rank correlation analysis. And finally, the webinar will end with concluding remarks. Let us begin with the background section. Now, there has been a lot of research on factors, so in this slide, I would like to just present a brief one-slide overview of the evolution of factor research and development. And factor theory goes back to the 1960s to the capital asset pricing model that established the first single factor model based on momentum. Then in 1993, Fama and French presented their seminal paper that extended market with two additional factors, size and value. In 1997, Carhart suggested the four-factor model that introduced the momentum factor. Then in 2015, Fama and French augmented their model with two additional accounting-oriented factors, profitability and investment. Now, during the last 2 decades, we witnessed the exponential growth of factor development. For example, it was demonstrated by recent reviews in 2016 and 2019 for approximately 300 and 400 factors, respectively. Now, most of these factors have implementation issues such as out-of-sample performance, liquidity, or trading costs. And within what has now been coined the factor zoo, there are, however, still a few risk premium factors that are generally accepted for investing. For example, MSCI uses 6 of these factors for its single factor indexes, such as momentum, quality, size, value, volatility, and yield. Within the Quantopian environment, the corresponding style factors together with the sector factors correspond to the Quantopian risk model. Momentum is one of the most dominant factors and therefore the focus of this paper. Again, following chronological order, The momentum effect was documented by Jagadish and Titman in their 1993 paper, where they showed that buying past winners and selling past losers generates significant positive returns. In 1997, Carhart captured this momentum effect in the conventional winners minus losers factor and used it for developing the four-factor model. In 2012, Moskowitz, Oy, and Peterson found the momentum effect in asset time series and proposed the corresponding time series momentum strategy. In 2013, Asnis, Moskowitz, and Peterson showed that the momentum effect generates significant positive returns across 8 diverse markets and asset classes. Also in 2013, MSCI launched its MSCI USA Momentum Index. The following year, Asnis and team published an influential paper entitled Fact, Fiction, and Momentum Investing, where they debunked 10 of the common momentum myths, such as there's no theory behind momentum and regarding trading costs. In 2016, Geksi and Samanov contributed to the literature by extending the stock data back to 1800 and showing that momentum is not a product of data mining, but is persistent. The following year, as the name of the paper entails, Hurst, Oy, and Peterson showed a century of evidence on trend-following investing. And then recently, Gupta and Kelly also showed the momentum effect in a large base of characteristic-based equity factors. Similarly to other factor indexes, however, the momentum return behavior is susceptible to intervals of underperformance. The analysis and explanation of momentum's underperformance was addressed by several papers. In 2001, Grunke and Martin explored momentum time-varying exposure to the market and proposed a hedging strategy. Then in 2016, Daniel and Moskowitz demonstrated that this hedging strategy, however, fell short with ex-ante data. Barroso and Santa Clara showed in 2015 that the market risk in the beta hedging approach only represented 23% of total winners minus losers risk, and therefore proposed to scale the WML factor with momentum realized volatility. Then recently in 2017, Morera and Moore demonstrated this volatility scaling strategy across a wide range of asset pricing factors. This effect is illustrated by the figure where the volatility scaled approach in green outperforms the conventional momentum factor in purple and excess market in yellow for the market downturn interval of 2005 to 2010. The next section will overview the proposed volatility timed winners approach. In short, the study addressed 2 primary objectives. First, enhance the performance of the volatility scaling approach. And second, further extend the corresponding analysis to the recent post-crisis period. In this figure, again, as we showed in the previous slide, the scaled approach overperforms the conventional momentum factor and excess market for 2005 to 2010. And for the 2011 and 2018 interval, the scaled approach performs better than momentum, but slightly less than excess market. Now, these results were computed using data from the KR French data library. And going forward, the goal was to conduct a deeper analysis at the asset level. And therefore, this study transitioned to the Quantopian open platform that contains the necessary data and processing tools. As shown in the notebook, the previous figure can be obtained via a few commands. Specifically, we define and run the pipeline with a momentum class for calculating momentum prior scores. Then, we retrieve the prices for the momentum assets. After running the pipeline, we can switch to the post-processing AlphaLens toolset for computing the forward returns quantile rings, and returns for the factor quantiles. And finally, having the deciles, one can construct the conventional winners minus losers momentum factor. To gain insight into the behavior of the conventional winners minus losers momentum factor, the analysis was extended to analyzing the winner and loser components. In this figure, for example, if we focus on the interval from 2005 to 2010, we see that when excess market, which is in yellow, begins to recuperate around 2009 after the market downturn, the losers and winners switch places. So in other words, the losers that are in blue start performing better than the winners, which are in green. This trend reversal was also identified by Daniel and Moskowitz in their research on momentum behavior during crashes. Therefore, the volatility-timed winners approach in the study proposes two extensions to the conventional cross-sectional momentum factor. First, replace the conventional winners minus losers momentum with the winners only component. And next, as you can see from the figure for both intervals, momentum downturns are associated with the volatility bumps, and therefore this approach also proposes to substitute constant volatility scaling with the threshold function and use past volatilities as a timing predictor for changing strategies. As shown in the formula and figure, whenever volatility surpasses some threshold, and this threshold is presented in the figures as the red dotted line, then this signifies that the strategy in these intervals should be revised. Essentially, the primary interest was the conceptual problem of interpreting volatility as a timing predictor for identifying intervals with broken momentum behavior. In addition, within the Quantopian platform, we can apply PyFolio for analyzing the corresponding strategies. In this slide, we see the summary statistics of the PyFolio tier sheet for the W10 and W10 timed approaches. And as shown, when comparing the timed approach in comparison to W10, the annual return is higher, annual volatility is lower, and max drawdown is lower, less negative. Till now, the study was conducted on research factors. And as you know, there is a trade-off between exposure and investability that can be visualized as a pyramid, where pure research factors are at the top with high exposure, but low investability. And in accordance with the pyramid, the study proceeded towards assessing the approach with index data. The table here presents the end of horizon cumulative returns and descriptive statistics for 8 MSCI developed market indexes for both the original MSCI data and the timed approach. Comparing the cumulative returns, for example, the timed approach shows improvement. Then the MSCI analysis was extended with US data going beyond 1999. The 1980 to 1999 period, which is on the left, included the Black Monday from October 1987, and that, as shown in the figure, was captured by a spike in realized volatility. In contrast with 2008, which is on the right plot, the rate in market recovery after the 1987 crash was faster. Subsequently, the figure shows the volatility-timed winners approach implemented with both 3 and 6 month realized volatility. The differing effectiveness of realized volatilities with distinct durations, as evident in the figure, implies the need for further considering the timing predictor for various market scenarios. Here in this section, the approach will be considered within the context of the time series momentum and risk-based asset allocation. Momentum factor is related to the alternative time series momentum strategy developed by Moskowitz, Oy, and Peterson. This strategy is asset-oriented, and as shown in the formula, involves using the asset's own past behavior for determining whether to go long or short the stock. This approach is combined with volatility scaling, and the TS-MOM volatility scaling was shown by Baltas to be a form of volatility parity. Now, volatility parity is a part of risk parity, which in turn is part of a larger domain. This domain is risk-based asset allocation. In contrast to mean variance portfolios, risk-based allocation bypasses the asset means estimation error and determines the weights only from risk measures. The four main approaches are naive, also known as equally weighted, global minimum variance, which is the only mean variance portfolio included in this domain, most diversified portfolio, which aims to optimize diversification, and risk parity, where the asset-weighted marginal contribution to risk is equal to a constant. When the pairwise correlations are ignored, the risk parity approach transforms into volatility parity, which was used in the time series momentum in the previous slide. The long-only returns of the TS-MOM strategy can be written as the volatility parity returns scaled by weighted volatility. Note, VP10 weighted volatility was based only on the winners with positive prior returns, since the equation represented a TS-MOM long-only strategy. As shown in the figure, the volatilities for both portfolios captured the momentum crash, although VP10 weighted volatility, which is in purple, at a higher level. The comparison between the momentum factor and time series momentum were addressed by several papers. This figure hints that the main difference lies in scaling, and this will be demonstrated in the next slide. Comparing volatility parity, time series momentum, and volatility timed winners highlights a couple primary points. First, in comparison to W10, which is in light green in the figure, VP, which is in purple, did not contribute a substantial effect during the 2005-2010 interval. And second, the difference between W10 and TS-MOM 10 was determined by volatility scaling. In Quantopian, volatility parity and time series momentum can be straightforwardly implemented as shown in the notebook through the corresponding pipe classes, VP10 and TS-MOM 10. And in addition, here, rather than applying alpha lens, the W10 were selected using the pipe filters. The next section will now analyze the Spearman rank correlation analysis. The Spearman correlation coefficient was introduced over a century ago and is calculated as the Pearson correlation for ranked variables. As you can see, the coefficient is consistent for analyzing the momentum effect, which, to remind you, reflects a trend over certain time intervals where winners continue winning and losers continue losing. Furthermore, it is implemented in the alpha lens package, and here are the corresponding code and plots. In both time intervals, as shown in the figure, RC time series exhibited an oscillation pattern. With the excess market cumulative returns on the rise, the correlation coefficient was positive. During market downturns, on the contrary, the oscillations increased and shifted to the negative. The next slide will summarize the corresponding statistics for both intervals. Here, the corresponding Spearman correlation statistics are presented for momentum data and volatility time data. For the latter, but intervals with high volatility were identified via realized volatility and excluded when computing the statistics. As you can see, the volatility-timed approach resolved and enhanced the risk correlation between the momentum prior and forward returns, as shown by the significant p-value of 0 during the 2005-2010 interval. In addition, the dominant positive part of the RC time series for the 2011-2018 interval subsequently made the correlation significant and was consistent with the findings by Jugadish and Titman. In summary, here are the concluding remarks from the paper and the webinar. First, the paper highlighted the broken behavior of the conventional momentum factor during a market downturn and proposed the volatility-timed winners that applied past volatilities as a timing predictor to mitigate momentum factor performance for time intervals spanning the market downturn and post-crisis period. Second, the proposed approach was confirmed with Spearman ring correlation and demonstrated in relation to different strategies, including momentum, volatility scaling, risk-based asset allocation, time series momentum, and MSCI momentum indexes. In addition, these two slides outline the references for this webinar. They are in alphabetical order, and most of them were also cited in the paper. And with that, I would like to thank everyone for joining and open the floor to any questions you may have.
Okay, everyone. So now we're going to move into the Q&A portion of the webinar. I will be picking questions from the live chat, and Yulia will be answering them. So if you have any questions that you haven't posted yet, please post them now. The one question that we already have is from Beach Capital, and they're asking, what's the underlying cause of the momentum effect, wisdom of crowds or madness of mobs?
Sorry, the wisdom of crowds or?
Madness of mobs.
All right, so that's an interesting question, and it's actually addressed in the paper by Asnis and team about fact fiction. I'll just go back so everyone can see. And momentum investing. Okay, good. So yes, the 2014 paper by Fact Fiction and Momentum Investing. And essentially, that's a good question. We don't really know. There's pretty much two camps. Is it because of the risk premium model, or is it behavioral science? And that's, from my understanding, still an open question and to be determined.
So the next question asks, how do you select the cutoff for the volatility threshold?
Okay. Okay. So at this point in time, as I also mentioned on the thread, it's essentially by looking at the past performance of the realized volatility, as this figure shows, and cutting off that high volatility bump, pretty much. So whenever because what we see from this picture is that high volatility is associated with a momentum downturn. And so yes, there's still room for developing a model for determining this threshold, as I also mentioned in the thread.
The next question asks, what is volatility scaling? Could you explain it shortly?
Sure. Volatility scaling is, I'll just go to the slide with time series momentum because it has volatility scaling there. So yeah, so here, for instance, for time series momentum, you have the target volatility of 40%, and you're trying to leverage it. So you're scaling the target volatility by the asset's volatility. That's volatility scaling.
And then there's a second question from Beach Capital, and they're asking for volatility weighting. Are you using volatility of returns from the momentum factor or volatility of the factor itself?
From the W10 decile.
A follow-up question from them, they're asking, have you considered using a more gradual factor tilt rather than cutoff?
So by focusing only on the threshold, I will just say that we're changing the scope of the research. But essentially, yes, there is room for improvement for the, I would say room for development of the threshold cutoff. It could be a tilt, it could be a model with significant variables, future research.
There's another question asking, are there enough high volatility periods for that to be statistically meaningful?
For what?
Momentum factor reversal correlation.
Okay. So we're sort of delving into the hypotheticals. In this paper, using different backtests for MSCI data or the FAMA French US data going back to 1980, there's quite a few of these reversals. And also, if you look at the papers by Barossa and Daniel and Moskowitz, they're massive. So essentially, yes, maybe this great 2008 market downturn doesn't happen all the time, but when it does, well, people feel it. So it might be a good idea to consider the threshold.
So that's it for all the questions that we have for right now. So I'm going to wrap up the Q&A portion of the webinar. If you have a question for Yulia that hasn't been answered yet, you can post them in the comments of her original forum post, link in the description of this video right here. This webinar has been recorded and will be reposted on our YouTube channel within a few days. And a link to her original post will also be in the description of that video when it's posted. You can subscribe and press the notification bell to be notified when we post a new video. Thank you all for joining, and thank you for your great post and the webinar, Yulia. Have a great day, everyone.
Thank you.